Michael, how are terms, risk assessment, and underwriting practices changing in the face of the crisis?
I think you see a lot of it, especially with terms. In New York in general, a lot of fix and flip lenders are waiting till construction to return until they issue a loan. At the end of the day, if you're giving somebody a 12-month or even 18-month term, knowing that construction might start in 2 weeks or it might not, you don't want to set up your borrower for failure, even though they might be able to start their permit process. You want to make sure that they get their construction complete, they're able to market the property and sell it. I think the terms of the loan and the actual loan term itself, those are a couple things that are going to change the face of this. Risk assessment also, certain property types are going to get favored and certain ones aren't. A lot of people have seen a very big hit to retail, so anything on the commercial side, on the retail side. So if you have mixed-use properties, small shopping strips, malls, etc., some of them might have been hurting before, but I think this is going to hit them a little bit harder. At the end of the day, if you have a mixed-use property with 4 residential, and if you have the nail salon and another business that would have shut down as the 2 bottom stores, a lender might not look at those as favorably, not knowing how long it's going to take until people do go back to those places and they could pay their rent and get into their spaces. I think residential properties will be looked at a lot more favorably on that side. Underwriting has changed a lot also. I think the experience is going to be one of the most popular things now in liquidity. They're going to look at those the most. Before COVID and getting into this crisis, a lot of the lenders in this space would only look at either 3 months bank statements or want to see 3 months of liquidity. You see a lot of that changing now. It's that also credit was going down. Some lenders wouldn't even ask for credit. Some people had a minimum of 600, 620. You've seen those go up to 680, 700 on the credit. Liquidity, they want to see 6 to 12 months, and they're going to ask for an interest reserve. So that's one of the big things on the underwriting side that's changed. Also, I think a lot of the properties that are going to be a little difficult on the bridge side, or the LTVs will be 50 and lower, will be the retail, office, and hospitality, until we see when people get back into work in offices and get back to those stores that are considered non-essential businesses. So you're going to see changes across the board, but on the terms, it's going to be the length of loan, and depending on your state and what condition it's in, the LTV is obviously going to be affected from that 75 to 90 range it was in down to 65 to 75. And you're definitely going to see most lenders, if not all, asking for interest reserve from 3 months to a year. So I think you're going to see a lot of those changes right now. When they'll go away, really, it's a hard thing to say with all the uncertainty with the virus and how it'll either curb itself or not, but hopefully as soon as possible.